Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers' reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. Today we are going to initiate a three-part series on how the stock market is at least temporarily hiding economic reality and why the powers to be can be counted on to print the money. We will expand on some foundational work in part 1 and 2, which we have discussed to some degree previously, before moving to the three unfolding stages we see ahead over the next few years. As you are already well aware, I have been ending these monthly videos with this slide for a very long time. What I hope to achieve in this three-part series is answer why this will happen via the facts, as opposed to simply an educated opinion. I believe the central bankers of the world are now trapped and will be forced to play out an already scripted series of policy initiatives. I also hope to show in the concluding part 3 why a Minsky melt-up will occur as part of these three unfolding stages. We are already in stage 1 as the Minsky melt-up is now underway. What I am sure is surprising to many is it is still in its early stages. Today I want to cover a key set of drivers that are shrinking the public equity pools in ways that few fully appreciate: the financialization of markets and the resulting shrinking of stock pools; 2, how our capital era accounting methods are obsolete; and 3, the changing role of equity exchange markets as a traditional way of raising public capital, all of which are resulting in elevated equity markets. Let's begin by specifically discussing the three distinct pools, which I categorize as the stock float pool, the exchange listed share pool, that is the actual number of listings available to the public, and the actual number of outstanding issued shares currently being reduced by the massive buyback phenomenon. We discussed the changes in the stock float pool earlier this year in a prior LONGWave video. I encourage you to revisit in our macro analytics library. For those that are new subscribers or missed it, I will briefly summarize its key messages. The market float is the number of shares actually available for trading. Float is calculated by subtracting the closely held shares that is owned by insiders, employees, the company's employment stock ownership plan, or other major long-term shareholders from the total shares outstanding. The float can be difficult to determine and therefore requires and depends on definitions. This is important. The public is unaware of how this is determined and generally have to pay service providers for this information. When a firm reduces the number of shares available to trade, then the so-called float manipulation can occur. This is well documented, and interestingly, one detailed report by Harvard Business School entitled "Float Manipulation in Stock Prices" spelled this out in 2005. We'll come back to that 2005 date. They proved with a study of 2,000 Japanese firms that the following occurs when the stock float is reduced. The price of the stock is often driven up. Stock prices are raised significantly when there are differing opinions about the value of shares, when risk-averse investors have different opinions, and a short sale constrained. Reductions in the float freeze out pessimistic investors, pushing up prices. When the float is released, prices fall. In actual fact, this is part of the S&P 500's dirty little secrets, and how quiet changes in the methodology have fundamentally transformed this index, which, by the way, correlates very closely with its dramatic rise. 3 examples of the S&P 500 index methodology have been quietly but substantially changed over the past 16 years. The 2005 float-adjusted market capitalization is the one that is really important and we'll discuss now. All are interesting changes, but we are only focusing, that is, on the one today. Since 2005, S&P 500 has been float weighted. This is a float adjusted market capitalization index. What does that mean? When the individual market cap is calculated for a company, part of the index, only the outstanding shares that can be freely traded without any restriction are taken into account. As we previously mentioned, not all outstanding shares of a company are available for common investors to trade. For example, shares held by individuals with access to insider information are under special regulation. Another very interesting adjustment that could change the weighting of a stock for big holders and then be fluidly changed back when that circumstance changed because they asserted they no longer had insider information. You can see how this game could be played. To put all this in perspective, the float adjusted value of the S&P 500 index in 2016 was around $1 trillion smaller than the unadjusted total capitalization. A research report by Horizon Kinetics uses Microsoft as an illustration. Had these rules been in effect during the 1990s, what would it have done for index fund investors? Had the float adjusted index weighting method been in place at the time, as insiders sold, for example, such that the float increased, the index rules would have increased the Microsoft weighting, and mutual fund and other index investors would have been buying more of what the insiders were selling. And I need to stress here, this was all before we brought in ETFs, which now command the market and follow indexes in a dominant fashion. Shareholders concerned with the control of company generally include the following. This is quite a list and a growing list. Additionally, the following holders' shares are generally considered part of the control block. In other words, the actual float available to trade is shrinking dramatically. As we will discuss in a moment, private equity purchases are having a profound impact on the public available float. But it gets worse, much, much worse. The shrinking number of share listings and the shrinking volumes of outstanding stock is also shrinking. The phenomenon we are witnessing in this regard is both unprecedented and fascinating. Stocks are vanishing before our very eyes. Stocks are disappearing at an alarming rate. At the current rate of stock vaporization, the average large capitalization growth stocks, according to work by Louis Navellier, will disappear in approximately 17 years. In theory. If that sounds crazy, check this. The entire S&P 500, according to his work, will disappear in 27 years. You may want to pay attention to those great stocks now before they're gone within a generation. Stock markets have in recent years been shrinking by listings, but not by market cap. There are fewer firms listed on the U.S. exchange than 40 years ago. In 1976, the United States had 4,943 firms listed on exchanges. By 2016, it had only 3,627 firms. From 1976 to 2016, the number of exchange-listed firms actually has dropped by 27%. According to data from the Center for Research and Security Prices at the University of Chicago Booth School of Business, in the mid-1990s, there were actually more than 8,000 at that time, of them being reduced by 2016 to that 3,627 number. On the other hand, the population of the United States has grown by nearly 50% since 1976. The drop is even starker on a per capita basis. There were 23 publicly listed companies for every million people in 1975, but only 11 in 2016. In Germany, for example, the number of listed firms fell by 41% during the past decade alone to only 450. Listings are growing only in China and other parts of Asia, which converted to capitalism only recently, and I believe this phenomenon is still in front of them. The number of publicly traded companies on the major stock exchanges has been cut nearly in half between the end of 1996 and 2016. The reasons include 1. Mergers and acquisitions, 2. Fewer IPOs, and we're going to talk about that more buybacks by private equity, and we'll talk about that more, and a few bankruptcies along the way, and more to come when zombie corporations are forced to face realities when higher interest rates come home to roost. Also, many companies are going all the way into oblivion by buying up all their shares over time and going private or dark. Many executives become tired of the quarterly rat race of reporting numbers which may beat or miss the expected earnings target by a penny or two, and so the stock gets hammered. They don't want to manage towards quarterly expectations which they consider to be unhealthy short-term focus for a company's long-term health, so they take the company private in some instances, and more considering by the day, and is one of the reasons that in the last couple of weeks prompted Trump to raise this issue as something that needs to be changed in the regulations. However, the big kahuna is not what I've just discussed. It's buybacks, or the actual reduction of shares outstanding by major publicly traded entities. As big as $3.5 trillion in buybacks has meant over the last 5.5 years, it is only getting larger. Trump's tax decrease have now meant even higher rates of buybacks in 2018. Companies are expected to authorize more than $1 trillion in share buybacks by the end of this year, according to Goldman Sachs projections. What we have is a sequence of overseas money now coming home. Companies then buy even more of their own stock, shares outstanding decreases, prices go up, while rates remain low, forecast PE multiples remain low, companies therefore then continue to buy back shares, and we just repeat the cycle. Low interest rates spur corporate borrowing through debt issuance. They take the money and buy back shares. Tax reform is allowing a massive repatriation of foreign money to come home. Corporations are taking the money and buying back their shares. As the outstanding float goes down, share prices go up. This chart shows the incredible shrinking stock market best of all. We can see that the gross issuance of new stock is rapidly decreasing. The number of outstanding shares is dwindling. The stock market is slowly vanishing. It's dying in front of our eyes. The bottom line is, as long as bond yields and forecasted PE ratios remain low, stock buybacks will persist, especially while return on equity remains high and cash flow remains strong. The average large capitalization growth will disappear in approximately 17 years at the current stock buyback price, as I said earlier, work done by Louis Navellier. Let's switch to driver number 2. That is an obsolete capital era accounting method. Accounting assets are increasingly not tangible. Our capital-based accounting system has become flawed. Our accounting system, which largely date to the time of people like Karl Marx, treat these two types of capital formation unfairly. The capital era-based accounting system is increasingly becoming obsolete. 10Q and 10Ks are seldom even read anymore by the professionals because they are found to be wanting. There's just not enough information in them, or real information in them. CapEx, that is, i.e. spending on machines, factories, and such as a share of assets, is steadily declining. Simultaneously, research spending on intellectual property keeps rising and already tops CapEx, or capital expenditures. A quirk in accounting is at the root of some of that profit deficit, especially for smaller and younger companies. Increasingly, value resides in intellectual property, that is, intangibles like software and data and biological design, rather than in the production of physical objects like cars. But under generally accepted accounting principles, our GAAP, which American companies must follow, research and development must be deducted from corporate income, and those charges can reduce or eliminate profits. Capital expenditures and physical things like factories appear on the corporate balance sheet, not income statements, and don't reduce the profits. A firm that spends $1 million on research and development must record this as an expense, thus probably, if it is a startup, wiping out earnings, even if it has just found the next big thing in its lab. Official profits are thus becoming almost irrelevant, while for company founders they seem increasingly misleading. If managers tell the markets too little about their patents, their firms will be undervalued. If they tell them too much, rivals will know their secrets. Better to just find private equity and be done with it. Our visibility into the inner workings of public companies isn't great, but we know far more about them than we do private companies, which aren't required to disclose nearly as much, if any, information. And these changing dynamics mean we know far less about many of the creators of Americans' profits and jobs than would otherwise be the case. And there are many players taking full advantage of this misunderstanding, specifically private equity. What we also need to appreciate is that the role of exchange-traded markets is changing from primarily being about raising capital to being a payout machine to investors in the form of buybacks and dividends. Capital being raised differently. It is being raised through debt and by different players. The reason is that in stage one, that is the pre-IPO enterprise, it's about innovation, cycle time, where the value proposition, that is investing, is in value, and that is what is critical. Increasingly, private equity plays here. In stage two, that is the developed and mature enterprises, are about profit growth, dividends, and stock appreciation. That is the returning of capital, and that's where the public exchanges and stock appreciation are playing. Without deep knowledge of a company's critical research, which businesses may be reluctant to share for competitive reasons, it's difficult for outsiders to evaluate a startup or early stage company properly. That makes it harder to obtain funding, and it may be partly responsible for certain trends. Why there are fewer initial public offerings these days, why smaller companies are being swallowed by the giants, and why so many companies remain private for longer. Profits in the overall market are now divided among fewer winners, and as capital-intensive companies have been supplemented by those whose value is largely found in their intellectual property, the market is less transparent with troubling consequences. That creates opportunities for private equity firms, which have insider access to innovative startups that may never go directly to the public markets. Meanwhile, Main Street investors are consigned to a less diverse universe than they may fully realize. The top 4 U.S. PE firms had over $1 trillion in assets alone. This is up dramatically in the last 10 years. Shown here in tan, you can see the growth is going up exponentially. Investors are clamoring to get in. What is their strategy? One thing we know is that they historically or traditionally haven't been starting new companies, but rather buying existing public companies, leveraging them up with debt, merging them with other strategies that are stock price oriented. Recall that their shares are those removed from the float, of course, until they are sold. Meanwhile, as they hold them and their stock goes up, they have more collateral with which to increase stock buying leverage. It must be a wonderful ride for them right now. Private equity is notorious with loading up debt on takeovers. Things have progressed further now, in my opinion, and this is really important. Today, they don't need to have total equity control, but rather just boardroom control. Board positions can come from being a major debt holder or arranging for debt versus simply their equity position holdings. I have been told by reliable sources that private equity firms now have control of over 60% of the S&P 500. As we discussed in our recent zombie corporation videos, the problem of debt payment levels versus cash flow and profits is becoming a global issue. Whether zombie corporations or challenged firms, the numbers are once again worrying. Clearly, the disconnect between their debt and productive capital stock doesn't bode well for the future. Debt issuance has actually been growing. Companies are issuing debt to help facilitate buying back more stock. This would mean outstanding stock is shrinking. That's precisely what this chart shows. New stock issuances in non-financial corporations is negative 391.3 billion at last count. What is going on is something we projected many years ago, a massive debt for equity swap. Corporations are swapping debt for their equity. The debt holders are becoming controllers of companies. That is, in many cases, private equity firms. And when the stocks fall, equity holders may get wiped out, but the debt holders will be paid unless the company goes bankrupt. And even then, the debt holders only squabble over the remaining asset division, while equity holders go without. To summarize the three we have been just talking about, I've put them together in this particular summary chart. In part 2, we will discuss the distortions and problems associated with passive investing. The growth of ETF index trading has grown dramatically, as have the issues associated with it. I have mentioned numerous times my concern with the ETF dynamo. We'll discuss it further in the context of what we have just discussed. As I often remind our listeners, and as I said at the beginning, remember they'll print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are effectively now trapped by policies of unsound money and fiat currencies. I'd like to take this moment as a reminder: do not trade from any of these slides. They are simply for educational and discussion purposes only. Thank you for listening, and until next month, may 2018 be an outstanding investment year for you and your family. And I sincerely thank you for listening.